Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 111th CP program organized by AASP of ICI. And again, today's topic is very important and very relevant. That is key audit considerations in the audit of metals, mining, oil and gas sector. As you all are aware that we have covered various sectors like telecom sector, like healthcare sector, like power sector. So today we are going to cover two very important sectors, metals and mining and oil and gas sector. And in order to tackle very two important sectors, we are having with us two eminent speakers, CA Amit Chugji and CA Kirthana Hariharanji. So on behalf of AASP of ICI, I extend my warm welcome to both the speakers. Welcome to you, Amitji. Welcome to you, Kirthana Madam. We are also having with us two moderators of the day, C. Rakesh Kedia ji and C. Ankit Sharma ji. So, on behalf of AASP, I extend my warm welcome to both the learned moderators of this today's webinar. So, Honorable Chairman and Vice Chairman both are stuck up in one of the another meeting. So, I'm taking this liberty to start today's webinar. And I request C. Rakesh Kedia ji to please start the webinar. Over to you, Rakesh Kedia ji, please.
Good afternoon, everyone. First of all, I would like to thank you, Chairman of the committee, C. Sanjeev Singhal sir, and Vice Chairman C. Vishal Doshi sir, for giving me the opportunity for being a moderator in this session. Indeed, it will be a great experience for me. I am delighted to welcome you all in the webinar, which is being organized on key consideration in audit of metals, mining, oil and gas sector, which is being organized by Auditing and Assurance Standards Board of ICI. We are excited to have you here. Today, there will be two sessions. In the first session, our eminent speaker will be CA Amit Chokji, and in the second session, CA Kirthana Hariharan. CA Ankit Sharma is co-moderator with me in this session. Before we begin for the technical session, I would like to introduce our first speaker, CA Amit Chok sir. CA Amit Chok is a chartered accountant and a BCom graduate from SRCC. He has 23 years of experience with SR Bartley Boy Audit Division and become a partner in 2016. He is a past member of ASB Accounting Standard Board and a technical reviewer with the FRRB and associated with ICI on various other forms over the years. Amit loves to travel and is a marathon runner and a cricket enthusiast. Now, I will request my co-moderator, C. Ankit Sharma, for introduction of our second speaker. Over to you, C. Ankit Sharma.
Thank you, Rakesh Kedia, and good afternoon to everyone, and welcome to all the delegates. And today we have Kirthana Hariharan, the Senior Manager in SR Bartley Boy and Company, and she is a Chartered Accountant member from the ICAI and also holds a bachelor degree in Commerce from Osmania University, Hyderabad. She also have a great experience in auditing and accounting profession and has an experience in audit of large domestic, international and listed entities. She has a specific experience in the metal mining, oil and gas sector, and she will deliberate today on this matter in detail. Over to you, Rakesh Kedia ji, for proceeding further.
Thanks, Ankit, for the introduction. Now, I will invite CA Amit Chok Sarji for the technical session.
Thank you, Rajesh. Thank you, Ankit ji, and thank you, ASP, for giving us this opportunity. May I request if the presentation can be put up? So today we have been covering two sectors, metals and mining sector and oil and gas sector. As a part of this series, Anilji already introduced that we've been covering various sectors. And these two sectors have not been discussed so far, being a little offbeat in nature. If we think of oil and gas, metals and mining, the first thought that comes to our mind is that, some very few large entities are only involved in these two sectors, and there is very limited exposure that we as practicing chartered accountants or members get in these two sectors. But the way we've kind of set up this presentation is in three parts, and then of course we can take your questions. The first part, we kind of like to tell you about what these two sectors are and why are these important and relevant to us. and also some of the peculiar accounting nuances that come out due to the inherent nature of these sectors. So in the first part of this 2 hour session today, we'd be covering some basic details about what these sectors are, why are these important to us, and how are some of the accounting nuances which emanate out of these sectors, and how those are different from what we would see in a normal enterprise or a normal industry. In the second section, we would be covering the key accounting issues and some of the audit consideration that one must consider while looking at those accounting and auditing considerations while audit of these sectors or working with these sectors on the accounting side. And in the third part, we would be covering some of the key audit matters that have been reported in the large metals and mining company, oil and gas companies, not just in India, across the globe, and some of the audit procedures that the auditors of those enterprises have quoted, and that is information available in public domain. Also, as a matter of fact, why we would be covering the global enterprises is because this is an evolving sector in India, and some of the practices that we see globally are much matured practices in the metals and mining space and in the oil and gas space. And India, with its growth journey, with its evolution in these sectors, and with the maturity that is coming in this sector, is moving towards international practices. And hence, we thought that considering some of the global examples would also be relevant in the overall context. So we move to the first part of this whole session, and in the end, of course, time permitting, we'll definitely like to keep 10 to 15 minutes for any questions members may have on anything that we have covered today, or anything that you'd like us to answer on sections that we may not have covered. So moving further, can you move to the next slide? We'll now discuss about what these sectors are, and why it is relevant to kind of cover this. So if we look at metals and mining to begin with, now this is one sector which is a part of the core sector. So there are 8 core sectors that the government of India identifies. Both metal and mining and oil and gas are a part of the 8 core industry that India as a country identifies. And if we look at in last 7 years, 6 years, they have seen a CAGR of 3.6% on the production side. Now, why do we mention production size only in this as a growth aspect? Is because under this sector, okay, both these sectors actually, the pricing at which your product is going to be sold is actually not in the hands of the manufacturer. And that makes it very different and unique in its own context if you compare it to a normal industry. The pricing is governed internationally by the LME, by the index prices, whether you talk about metal, whether you talk about oil and gas, whether you talk about natural gases, all of these natural resources, the manufacturer of the product has no bearing on the price of the product. And which is where, when we look at the growth in the industry, the production quantity is a better barometer when we look at. And in fact, because of the fact that the pricing is not in the direct hands, has its own accounting implications also, which we would be covering towards the later part of the session. Now, when we talk about metals and mining as a sector, it is not just the expansion in its own sector which is driving the growth. If we talk about construction, automotive industry, electronics industry, any industry, core industry, if you look at, metals and mining is actually a key input in all of these sectors. So is oil and gas. So when we look at growth in the industry, in the country, in the global context, metals and mining is bound to grow. And when it grows, all the ancillary sectors along with it grow alongside it. If we look at how it is contributing, as per the public statement made by the union minister, the GDP contribution from metals and mining sector is expected to be 2.5% of the total GDP, which in a way means that this sector is likely to contribute significantly to the growth journey of the country. When we talk about metals and mining, India as a producer is the largest producer of coal in the world, largest producer of cement in the world. And with the thirst on electricity and India being the third largest consumer of electricity today, and it is likely to in fact surpass US also by 2030, coal still continues to be the primary source of electricity in our country. More than 60% of the total Indian electricity is actually by the thermal power plants, which would mean that metals and mining would continue to attract investment, would continue to be important, and all the industry ancillary to metals and mining would continue to thrive and hence continue to provide opportunities for the members. If you move to the next slide. Uh, Now, if you look at what are the key drivers here, so the demand is growing by 3% every year. If we look at the policy changes, the policy support that the government is providing, there is immense. There are steps being made to reduce the barriers to participation. There are greater amount of auctions that are happening today for mines, which brings the real transparency in the sector. More and more mines are now put up for online auctions, which is something that we've not seen before, and which is something that is going to drive further growth in the industry. If we also look at capex, again, and this is true for both these sectors, these are extremely capital intensive sectors. Whether we talk about metals and mining, which is highly capital intensive sector, it has seen 12,900 crore of investment in December 23 for this particular year. And if we look at for the next few years also, a heavy amount of investment is expected. India over here would continue to attract this investment primarily on account of its rich nature of oil and gas and metals mining resources that as a country we possess, and also for the distinct cost advantage that India has. Now, cost of production of metal in our country or natural resources in our country is actually lowest across the globe in a lot of key sectors in the metals and mining and oil and gas space, which would mean that in spite of being highly capital intensive in nature, they would continue to attract investments from the global investors, which would again, as I said, mean more and more opportunities. And how this impacts the accounting is more the amount of capex, the principles and the manner in which capitalization would happen in a metals and mining sector or in oil and gas sector is very different from the core industry, and which is again something that we'd be covering as a part of our later part of our session as to why it is different and why this is relevant. And again, because of the significant capital that this sector requires, this would also remain a key accounting and auditing challenge. Also, given again being capital intensive, another external factor which is extremely relevant to these two sectors is the interest rate regime. Because more and more companies which are participating in these two sectors remain highly leveraged and have high dependency on borrowed funds. A high dependency on borrowed funds would mean two things. One, of course, as a part of capitalization, the interest that needs to be capitalized, which again we'll be covering as to how borrowing cost is different when it comes to these two sectors. And also there is this huge dependence on these two sectors, which makes it unique compared to the other industry. Next slide. Now, coming on to the oil and gas sector, this again, these are very similar to each other, so we thought that it is better to club these two. So oil and gas sector, as we discussed, is one of the 8 core industries in the country and plays a major role in the overall economic growth and development journey of the economy. Uh, even in the oil and gas sector, there are significant relaxations that the government has brought about, which in a way attracts a large amount of FDI in the country. India is the third largest consumer of the oil, and that is something that would continue to be there going forward also. While on the crude side, we may not be manufacturing as much, but India, through reliance, through HPCL, IOC, BPCL remains one of the largest refiners in the world. So while we may not be kind of producing our own crude, but with these large enterprises and a whole lot of other ancillary industries that are associated with these large enterprises, India continues to be one of the largest refiners globally. Domestic oil only accounts for 10% of the India oil needs, which means that we are still majorly dependent on our overseas suppliers, whether it is Middle East or Russia or otherwise, for our oil needs. But from a refining perspective, India continues to be one of the key players in the global economy. And also, given that we are largely dependent, there is a huge investment that is going in for the new oil finds in the country. Oil and gas as a sector is much more capital intensive, even if we compare it with the metals and mining space, which would mean that again those factors around the prices, capex, and interest rate would have a much higher bearing on the oil and gas sector. Another very important factor that emanates from the fact that there is a high capital need is the fact that the capital need is so high that you would find very few manufacturing fields which would be owned by a single person, which would mean 3 or 4 companies would club together their resources to look at oil extraction. And when 3 or 4 join in together, there are auditing and accounting issues around how consolidation is likely to happen. How do you establish control? Whether it is line by line consolidation or a profit pickup like associate accounting. And again, some of those factors come into play wherein an auditor is to exercise its judgment and knowledge of these principles to come at the final accounting, and which again is something that we'd be covering towards the later part of our presentation. Next slide, if you move. And again, putting a little more focus on the oil and gas industry, India's projected demand is likely to double itself by 2045. And India is expected to, in fact, double its diesel and gasoline demand by 2030. The policy support on the custom side, on some of the other ease of business related measures by the government continues to be there. There is direct FDI that is required, 100% FDI that is permitted in this space. The FDI inflows in the oil and gas sector stood at 8.18 billion between 2000 and 23. In 23 years, that is the kind of inflow of foreign funds that we have seen in the sector. And this is besides the kind of investment government of India is making in some of the large PSUs that we have. So again, long and short, this sector continues to be very relevant, important for the country as a whole, and is a key driver in the economic growth journey of the country. Moving further, some of the developments and the whole industry issues that come along with this sector, if we go to the next slide, and which in a way mean that next one, that this sector would continue to remain relevant is the carbon pricing or special taxes that are imposed. Maybe you can call it on the environmental side, or because these are natural resources which have a limited supply side in a way. So there are carbon emission taxes that are being imposed by different countries. So currently, if you look at the global map on your screen, the ones which are this pinkish red color are the countries which are already having a regime which, in a way, taxes these countries, production in these countries. India is over here in light blue color, which means that it is under consideration and development. And if we move to the next slide, the timing that at least from the global understanding that we have with various summits that the government of India participates in, India is not likely to have these taxes, carbon prices taxes by 2050, which would mean that if we look at the competitive advantage of India, in addition to the cost benefit that we provide to investors on a global scale of things, by till 2040, which is another 2.5 decades, India is not likely to attract carbon price taxation, which means that India would continue to be an attractive destination when it comes to uh, investment in the sector. Now, before we delve deeper into the accounting issues, I'd like to kind of explain you few uh, terms which are relevant, which are peculiar to this industry, and which are relevant for understanding of these accounting and auditing issues better. So if we move to the next slide, so there are these five terms, or so to say, five stages of production life cycle or metal life cycle, oil and gas life cycle that you would see in this particular segment or both these sectors. First term, and all these five terms are used extensively along the accounting and technical guidance that is available in our country, whether in auditing standards, accounting standards, FAQs issued by the ICAI, and various other literature. So these five terms is something that you would very commonly see. So these are relevant for understanding of the accounting in the sector. First is exploration. So exploration is actually a phase wherein you are trying to explore or evaluate whether uh, there is uh, there is availability of natural resources at a particular place or not. So exploration could involve drilling, sampling, conducting uh, topographical surveys, soil surveys to see whether or not there is availability of natural resources at a particular place, space or not. The second stage, so this is the first stage, which is exploration phase. The second phase is evaluation, wherein you actually do so once you've explored that under a particular piece of land, for example, there is metal available, or there is gas available, or there is crude available. The next stage you move is evaluation, that while there is metal underneath the surface, is it possible to extract it or not? So you do a technical feasibility, commercial viability, that what is the kind of terrain that you're looking at? Is it a rocky terrain? Is it a normal terrain? Through the use of current technology, is it actually possible to dig out the natural resources out of it? Would it make the whole surrounding unstable? Are there emission norms being followed or not? Is there enough waste disposable kind of norms which are there or not? So in the second stage, you actually evaluate that while there is availability of natural resource, can you actually, or should you actually take out, and does it pass the cost benefit test or not? So that's your second stage. Third stage is development. In development, you actually pull out mineral and start your extraction of the metal. Now, when metal comes out, it could be in the form of a rock, which could have, say, for example, if you take out metal in a lead mine, so that rock that would come out would have silver, would have lead, would have zinc also. So development is when you actually extract a natural resource out of the ground, or out of the mine, or out of whatever you want to call that term as. Fourth stage is the actual production, wherein you segregate that thing and make it in a form and manner that it is available for use to the end user industry. And last, which is also very important and relevant, is the closure and rehabilitation, because none of the mines anywhere in the globe would continue to produce forever. So since these are natural resources, they have a limited shelf life, and would have first an increasing graph, because when the production happens, you begin with a lesser production, then the production reaches its peak. And then as the reserves continue to go lower, once you've extracted, the production kind of retracts and diminishes. So as the production diminishes and we have extracted all the natural resources out of the mine, there's a closure or rehabilitation also that is required to be done. And both out of the contractual liability and also the responsibility towards nature, one would have to kind of do closure of a mine or rehabilitation of that entire area, which is environmentally sustainable. That also brings us to a very important aspect on climate risk, on environmental social governance, and which is also something that we would be covering, because this is one area which is rapidly gaining attention in our country. and how, I mean, we'd also cover towards the later part as to how globally companies are more evolved when it kind of comes to ESG around climate risk, and India is kind of fast catching up. But today, if you talk about any forum, whether in board meetings, in the government advisory, in the government dialogue, in international conferences, there is a lot of focus on climate risk, on ESG, on sustainability of matters. And this being very core in this sector, given you are actually extracting natural resources, which are having a direct impact on the climate, on environment, on soil, on the nearby areas, given how it's being done. Climate risk and ESG remains a key focus area when it comes to this particular sector. And given it is a key focus area, so both from an accounting, reporting, and CAM perspective requires attention. Also from a perspective that from an estimates perspective, there is a asset retirement obligation liability, which is essentially around closure and rehabilitation, which is peculiar to this sector, which would become relevant, and which is something that we would be covering in detail towards the accounting issue discussion. So these are terms that you would kind of hear both of us speaking much more often over the next few slides as we kind of delve deeper into the accounting and auditing aspect. I would now request my co-speaker Keetna to take the accounting and auditing issues, and then we can take the questions. Keetna, if you can just.
Sure. Thank you, Amit. Thank you, Chairman Sir and Vice Chairman Sir, for giving me this opportunity to present. So the next few slides, we're going to be covering the auditing and the accounting issues that are pertinent to the metal mining and oil and gas sector. So we have structured this in a way that we will look at how generally the industries operate and how metal mining and oil and gas sector is different. And we'll go through a few examples to further understand the background behind why these issues are pertinent in these sectors. And then we'll look at the auditing aspect to it. So when we look at all these areas, we'll be able to holistically understand and appreciate the issues around the sector better. So the first matter that we'll be discussing is around the depreciation and depletion charge that comes to the P&L. So as Amit mentioned before as well, oil and gas and metal mining both being a very capital intensive sector, there's huge amount of capex that goes to develop a particular field and start extracting metal or oil or gas out of the surface. Because there's a huge cost that is sitting in your balance sheet, the depreciation charge also becomes a very important aspect in this particular sector. So usually when you think of depreciation, you would probably think it's a straight line method you would use or a WDV, which is pretty straightforward. However, when you look at the metal and mining and oil and gas sector, you will either see a combination of unit of production method and a straight line method, or you'll only see a unit of production method. So unit of production method is when you're charging depreciation in proportion to the assets or resources that you are extracting. So if you're producing a certain amount of metric ton from that particular area, so then you will charge depreciation to that proportion, and it's not like a fixed charge that's going to come over the life of the mine. And the reason why this is different from the other industries is that the standard allows you to systematically decide how you want to charge your depreciation over the life of the asset. And one of the key factors to determine how do I know what is the right way of charging my depreciation is to determine how you use that asset. So the assets are very long standing because it's the same asset. It's going to go throughout the life of the mine. So there's no general wear and tear. So it will be used in proportion to the how you use the or extract the outcome from that, like the mine extraction, ore extraction, oil extraction. So that is the most important factor. So more you extract the resources, more the depreciation, less you extract, less the depreciation. So that's a difference between what you see here versus the other industries. So we'll just look at an example in terms of how do you actually compute the unit of production method. So company ABC, which is engaged in the mining. Yeah. they've incurred expenditure of about 1,000 crores on the mine development as of March 31st, 2024. The reserves as of March 31st, 2024 is 100 metric ton, and the production during the period was 10 metric ton. Now, before we understand what unit of production and how to depreciate it, let us just understand these terminologies of what is mine development, what are reserves, and how do you know what you've produced during the period. So mine development expenditure is, like Amit mentioned, we've got various phases. You've got the exploration phase, you've got the evaluation phase, and then you've got the development phase, and then you're in the production phase. So typically, depreciation will start coming only when you move to the production stage, hatching concept. So any cost that you have incurred to set up that facility in order to extract the ore or oil will form the mine development, which would include your drilling costs. You'll do the blast when you're doing the mines, or if there's any data acquisitions, data studies that you do to determine where you have to set up your facilities. So all these costs sit in the mine development activities, which you would have to depreciate over the life. The term reserves is typically how much of prospect, your ore or metal, your crude oil that is there in the surface that you're available to extract in the future. So when we say as of March 31st, 2024, you've got 100 metric ton, it means that up from now till the life of the mine, you have 100 metric ton available on the ground for you to extract, right? And during the period, out of this, you had extracted 10 metric ton during the period. The term reserves actually means that if you are able to commercially extract something, that's when it comes to reserves. So when we had seen the earlier stage of exploration, evaluation, development, so when you initially start, like Amit mentioned, it's the you basically do some studies and you know whether there's prospect or not. So when you know that there's a prospect, that comes under the category of a resource, right? So you know that it's there, but you don't know if you can commercially extract it. So then when you move to your evaluation is when you know how much of reserves is there and how much of cost I'm going to incur to set up a facility here, and if it is cost effective or profitable for me to extract. So the moment that commerciality is established is when we move to the development stage, and which is when we set up the facility and it actually gets capitalized when it starts producing. So when it moves from the evaluation to the development stage is that point where you actually know that this is profitable. So that is when a prospect moves from resources to reserves, right? So now that we've understood these terminologies in a lot more detail, we'll understand how we compute the depreciation. So the closing asset, which is 1,000 crores, which is your mine development cost. The closing reserves is 100 metric ton. We'll understand where each of these figures are coming from. And then the production during the period is 10 metric ton. So your opening reserves is 110 metric ton. And your UOP is simply, it's your closing assets divided by your opening reserves, which is 1,000 divided by 110. So your unit of production is 9. So effectively to produce 1 metric ton, you are incurring 9 crores of expenditure. That's how you look at it. So typically, if I have extracted 10 metric ton of reserves this period, I've incurred roughly a cost of 90.9. So that would be your amount of depreciation that you will charge off to the P&L this year. Now, some of the auditing considerations that is pertinent in this is one is the production part. So we know that the 10 metric ton that you do, how do you know that if it's 10 metric ton? Because it's not something that you can, it's not tangible that you don't count it. There is a certain methodology through which, there's meter readings and certain other reportings that the function of all of that is how you determine how much of production you've made. So the easiest way to determine from a production standpoint is large companies generally do, regulatory reportings of how much of they've produced. So that is one way to audit how much of production they've done. Plus an opening, closing, inventory reconciliation is also something, that you can do. For smaller entities, meter readings and other lab tests reports can also be used to test how to test the production during the period. Moving on to the reserves and resources. So I explained how, the reserves and resources, each stage. So how do you know how much of reserves or how much of resources is there is actually, it involves a lot of, geostatistical studies, properties of the field, seismic data studies. So there's a lot of technical, geological aspects that go into this, which is typically done by your petro engineers or mining engineers, right? Of oil or mine specialists, basically. So they're not accountants. So for auditors, this becomes a huge challenge because this is a very important input, not only from a depreciation standpoint, but also for impairment, which we'll be discussing in the next in a couple of slides later. This is a very key input in this industry. So because we are not experts in this, to test the how much of reserves is there, you would actually use an expert. So generally the company either has an in-house expert who qualified in this particular field to do these tests and to determine how much of reserves and resources are there, or they would appoint an independent third party who would come and visit the field and see, study the properties, benchmark with past performance, and then determine how much of reserves and resources are left. So as from an audit standpoint, we would have to follow the procedures which is there under SA 620, wherein we'll have to see, first of all, given that, this, that as auditors, we would not be able to do this, we will not be able to reliably estimate how much of reserves and resources are there. Itself meets our first criteria over here is, do we need to use a specialist? Since we are not specialists, we would have to go to somebody given the importance of this particular input here. Now, if the company has either in-house expert or they have an external expert, it's important to see who is that person who is doing this estimate for us. Is he competent? Does he have the capability to perform this assessment? So generally in this industry, there are very few players who can actually do this activity. So in, I think in oil and gas, you have 3-4, D&M is there, Miller is there. So there are 3-4 players, both in mining and in the oil and gas, who can actually do this. So it's not that difficult to see whether somebody has the competence or the capability unless they are outside this group. So obviously, if they're outside from these top players, then you would have to do a lot more detail. But if they are from these top players, then I guess we've kind of checked the competence and the capability standpoint. And it's very important to make sure that they're from these key, the top category people who are doing this, because this is an evolving sector and there's huge amount of estimation that goes into evolving it. You'll have to, each mine and each, oil field is very different. So, the experts need to have that level of resource to accurately identify and determine that estimate also. And the third part to see is whether, the expert is objective. This is a very important aspect to see in this sector, because if the expert's fee is, based on some contingency, depends on the, what resources he quotes, or, some other parameters, which is indirectly or directly linked to the estimate that he's providing, that poses a huge risk from an auditor standpoint, to rely on their. So objectivity and, whether they are given any contingency fee or not is something which needs to be thoroughly evaluated before you decide to rely on their. The best way to do this is either you can look at the reserve report and see, if there are any caveats, in terms of the reporting. And most people also speak to experts and, ask these standard questions that is there from a contingency or, management pressure and things like that. So these are certain things that you would need to evaluate to determine whether you can rely on the reserves and reports. So once you're comfortable on the reserves and the productions, we'll move on to the mine development. So to test the mine development cost, it's pretty general. There's nothing unique, different from this industry. It's only the nature of cost is different, but typically the same audit procedures as you would do following Ind AS 16 and the audit sampling methodology. You would do your normal test. The only key aspect to focus on there is that, the assets must be in the producing stage. So, it should not be in an exploration or an evaluation under the resource category. And that asset that you are depreciating or intending to deplete is under the development category. It's already a producing well. That's the only additional focus that you would have to put here. Moving on to the next aspect, which is the exploration and evaluation assets. So typically, when we looked at our phases, which is the exploration, evaluation, so both of them are akin to the research segment, as you would use in common parlance in other industries. So in other industries, what happens is that, so when you are in the research stage, that is charged off to the P&L. So once the commerciality is established, that is when, those costs start getting capitalized, CWIP, and then eventually. But in this sector, it works differently. Here, the entity has the option to choose an accounting policy where they are allowed to capitalize, these research, which is the exploration, the cost that they incur in the exploration and evaluation phase. And once they're allowed to capitalize it, and then when, you keep doing the testing, and once you realize that I will not be able, there are no prospects, I won't be able to extract anything from this. So it's an unsuccessful field. That is the point when you actually charge it off to the P&L. So it works. So the other industries is that you capitalize it when commerciality is established, or when, the profitability is established. Whereas this industry works otherwise. It says you capitalize it until proven otherwise. So the moment it becomes unsuccessful is when you charge it off to the P&L. So again, some of the key accounting aspects to focus for this is that the critical point to note is that there needs to be a license to exploit. So both the oil and gas and metal mining industry, the structure is that, when the government bids for a particular area for you to tender, once you tender in, and you win the bid, you have a license to explore, develop, and produce. So once you get that license, after that stage is when you are allowed to capitalize it. So if there's any cost that you've incurred before the license, even though it may be in relation to that, the standard clearly says that you cannot capitalize those costs. So anything which you're incurring after is what you're allowed to capitalize. So that is one. So point is, you need to see whether the license to explore that particular area is there or not. Second thing is, you need to know that the cost is actually for the exploration activities only, because if the entity is venturing into multiple, things, and you need to then distinguish between what cost is for general admin and what is specific for exploration activities and other activities. So you'll have to break it down and remember to capitalize only the cost which is there towards the exploration activities. And then the third aspect is to keep every reporting period, we'll have to keep revisiting the cost which is sitting in the exploration and evaluation. It's actually shown as exploration assets, intangible assets under development in the balance sheet. So we'll have to, every reporting period, keep rechecking what is the status of testing. So the moment you know that there's a testing that is, proving that this is unsuccessful, that's immediately we'll have to charge that off. So you can understand this with the help of an example. So ABC Limited incurred 10 crores towards your pre-operative expenses. Then they receive a license to explore in January 24 for a period of 10 years. Post the license, the company has incurred 40 crores towards the exploration activities, which could be your data study, seismic data acquisition, people who, employee costs to analyze those data. So there's certain costs that the entity has incurred. So how do we know which of this cost is eligible to be capitalized as E&E assets? So the company has got a license period for 10 years. So the first aspect is checked off, which is the license is there. And clearly we know the nature of the cost, which is data studies, your seismic data, deciphering the data. So all of these are activities towards the exploration. So the factor is also checked. The third one, because you just started the exploration, so it's too soon to decide whether it's unsuccessful or not, but we will have to keep revalidating this at every reporting period. Clearly, the first point, which is anything which is after the license period only, will be eligible to be capitalized, which in this case is 40 crores. So because 40 crores meets the first two criteria, which is the criteria to be eligible for capitalization, 40 crores goes as intangible assets under development in the balance sheet, 10 crores is charged off to the. Third factor is abandonment cost or asset retirement obligation. So like Amit mentioned before that this is, so it's the government's land that, the companies get to explore, evaluate, and it's usually the mine life is pretty long. So it's like 40, 50 years you're exploring a particular area. Given the use of that land for commercial purpose, there's a heightened sense, for environment's sake to restore that land into the original state, which can be used for other purposes. Otherwise, you'll not even be able to use it for any other purpose. So because of the heavy commercial, change in the land, heavily you're drilling and you're blasting and your, pipelines under the, surface, it's made in such a way that it cannot be even used for any other purpose. So it's very pertinent, just from an environment perspective, to return that land in the state in which it was given to you prior to your exploration. So this is very common both in the metal mining and oil and gas sector. In India, the metal mining is there's a fixed, metal mining, the restoration, cost that you would incur. Whereas in the oil and gas, it's huge. There's a huge estimation involved to determine how much of cost you would have to incur to determine what abandonment cost you would expect to be incurring. So we'll get into a little more detail to understand how this is accounted for. So every contract that you enter into, both either from a metal mining or an oil and gas sector, this is a very common activity that they would have to do, which is restoring the land at the end of the period. Because it is a contractual obligation under Ind AS 37, you would have to determine what is the amount that you would incur to restore that particular land. Whatever amount that you identify or determine, that is capitalized as a part of the asset, and an equivalent liability is created in the form of a provision in the balance sheet. This asset that you've created is depreciated over a period of over the life of the mine, or the license of the asset, and the liability is unwound till the mine life. So this is how you recognize this. Now, how do you determine how much of cost do I have to incur? So in the metal mining contract, there's a fixed rate. So based on the fixed rate, you discount it and you recognize it. So it's not too complicated. However, in the oil and gas industry, there's a lot of different peculiarities to determine how this cost is estimated. So first, we need to identify how much of facility do you have to dismantle, because there's a lot of pipes, there's a lot of wells that is drilled, a lot of areas also that is connected. So it's working on a very large area. So we'll have to first of all identify the whole asset count that you'll have to dismantle. That is one. Secondly, what is the cost that you would incur if you were to do it today? So today you would have to probably request for tenders, or if you already done it for a particular well, then you use that as a base to determine how much of cost you're going to incur. Then, you determine when do I have to do it. This is the most important aspect, is that at what time, 20 years, 30 years, at what period am I obligated to restore or incur this particular cost. So in most cases, it would be the life of the mine or life of the field, but at times you could also estimate it to be the life of the contract if you have a shorter contract period. So that then you discount it. So the standard said you will have to discount it at the present value, which should be at the current market prices. So all macroeconomic factors like inflation, discount rate does also not only have an impact on your asset, it also has an impact on the potential abandonment cost that you would incur. So once you've determined whatever cost you have to incur, like I said, you have to capitalize it, and then you'll depreciate and unwind it over the subsequent periods. Now, each year you will have to redetermine the cost. Now, there could be two reasons why the cost can change. Either there's a change in the estimate because, you've added facilities, more assets have come in, or because of change in these macroeconomic factors like your discount rate has changed or your inflation rate has changed, the basic costs have changed. So when there is a change in estimate, the standard says that you have to adjust or you have to add or reduce that from the cost of the asset and from the WDV, remaining cost of the asset, and accordingly take a corresponding impact on the liability also. Only the unwinding portion goes into the P&L. If there's a change in estimate, it is directly adjusted to the cost and the liability. So again, the auditing aspect to focus on over here is that generally, if companies find it very hard, like in the oil and gas, it is not very easy to determine that. So they do engage experts to do this estimation for them. And again, like the reserves, there are a few players only over here who does this estimate. And similar to how we had done in reserves, the SA 620 procedures, the same procedures we'll have to do here as well, from a competence, capability, objectivity, and speaking to the experts to make sure that they have addressed all the concerns that we see from an audit standpoint. So let us look at a few examples to see how this recognition is supposed to be done in your books of accounts. So if your estimated cost of abandonment of mine is 2,000 crores at the end of your mine life being 20 years, your discount rate is 16%. So how do you determine what your liability should you recognize and what's the appropriate account heads? So abandonment liability is 2,000 crores, which we will determine either by expert or benchmarking it to the existing tenders or costs that you've incurred. Discount rate, again, you can benchmark it to your treasury bonds, whatever, quoted market data. So if you discount 2,000 for 20 years, you get the value of 103 crores as of today. So 103 crores being the cost of dismantling, you will capitalize it as an asset. So you will increase your PP&E or intangibles if it is for exploration by 103, and a corresponding long-term provisions, because it's after 20 years you're going to incur it, so you'll go to long-term provisions by 103. So this is FY24. So the next year when we move for the accounting, 103, which is sitting in your asset, that will get depreciated. So assuming the same factors that we had seen in the earlier case, 10 metric ton production and 100 reserves. So based on that, we computed the UOP. So that is coming to 10.7, which is a depreciation that you would charge the next year. And then 103, if you just, instead of discounting it for 20 years, if you discount it for 19 years. So the difference between the two is 16 crores, which you will book as a finance cost. So it will be finance cost to liability. So liability will increase by 16. So that is on when there is no change in the estimate and you're just unwinding and discounting. So the second scenario is, let's say you have a change in the estimate. So in the next year, you get to know that instead of 2,000 that I estimated, now it's become 2,500. So then in that case, what you would do, you would discount the revised value, and then you will compare it with the discounted value with the original rate. And then the difference between the two is your change in estimate. So like I had explained, the change in estimate would be added to your asset and added to your provisions, and nothing goes to the P&L. And then this revised value of your asset is then further depreciated, and the unwinding in the subsequent years is calculated on this revised value. The next aspect is borrowing cost. So we've already established that the oil and gas and metal mining sector both are very capital intensive. A huge amount of capex outlay goes into this industry. Plus the fact that even going forward, we know that there's a huge growth expected in this both these sectors for that matter. Huge FDIs are expected, which means that more amount of capex outlay is expected to happen. And given this substantial amount of capex involved, usually there's a huge amount of borrowing also that the entities take in order to meet these capex requirements. So when there's a huge amount of borrowing comes your interest cost. So both of these industries are very commonly capitalize their interest cost. So it's permissible, right? So under Ind AS 23, you are allowed to capitalize your borrowing costs, provided it is being incurred for a qualifying asset. Typically, there are multiple stages. You have evaluation, exploration, evaluation, development. So it is an asset which takes substantial time to get ready. So it does meet the definition of a qualifying asset. The only factor that that's different over here is that while in India's 106, we did see that exploration cost and evaluation cost is capitalized. However, from a borrowing cost standpoint, you can only capitalize the interest cost. Even though this being a qualifying asset, you will start to capitalize it only when it moves to the development stage. So when the commerciality is established, only after that stage you are allowed to capitalize borrowing costs. So again, this is something which borrowing cost capitalization is something that you would see that the difference is that here the E&D assets, though they meet the definition of a qualifying asset, you will not be able to capitalize borrowings cost to that extent. The next thing is impairment. So both the metal mining, oil and gas industry is so sensitive to macroeconomic factors. So any production cut, any war, any change in the fiscal policy, um, it has a huge impact on the demand supply uh, of this industry. So all the any change in the macroeconomic factors have a huge impact on this industry, because one is the capex is also so high, and the dependencies on those inputs is also because the prices is also externally governed, right? So if any change in the policy of war would impact production cut, would impact your price. So if it impacts your price, it will impact your recoverability of the asset. So it's very important to determine whether there is a trigger that is there in these in both these sectors. Every reporting period, extensive procedures are performed to see whether any of these factors exist, because it is more likely than not, if you look at the metal prices, they're so volatile. Few months back they were on like an all-time low, now it's coming to an all-time high. Similarly, if I look at the oil and gas prices, few years back it was over 100, and then it came down straight to 20, and then it moved, slowly caught up 40, and then now it's hovering around 80. So all of this is impacted because of the other macroeconomic factors that's going on. The production estimates, the demand, the sustainability angle that is there. Moving from your your thermal power or your fossil fuels to your renewable sources. So all of these factors have a huge impact. So again, the standard requirement is that at each reporting period, you will have to determine if there is any impairment trigger. If there is an impairment trigger, you will have to determine the recoverable value. And you'll have to compare that with your carrying value and determine if there's any impairment charge that is required to be recognized. So some of the very key indicators that you can see in both these sectors is prices, we've already discussed. Forex rates, even if your borrowings are there. So all of that also, if there's a supply chain disruption, that could impact your production cost as well. So if it's going to be a long-term issue, then that would also have a potential impact on the recoverable value of the asset. And, let's say, the borrowings have gone so high or the prices have gone so low, suddenly the cost, a project which might have been commercially viable when you did your initial evaluation studies and moved to development, now may not be viable anymore. So it'll move from, you'll have to stop that project. So you'll have to move from reserves to resources. And then that also indicates that that particular, CGU or, aspect of that asset triggers an impairment test. And then again, like we discussed before, if your discount rates, inflation rates move up and down, then the cost of your abandonment or restoration liability may also change, right? And your reserve estimates, which is your ore or your crude oil, they have also certain inherent, geological scientific factors based on which that estimate is made. Now, it's also possible that each time you get more and more data, that estimate also changes, right? So that will also change your reserve estimate. So if you have a huge, change in estimate, that could also result in a potential impairment trigger. And so these are certain, I think. And the last one is, of course, if you have any, additional taxes or change in the government policy. So in the oil and gas, refineries and production, SAED windfall tax was levied. So that also had a huge impact on that industry, which was evaluated, in most of the companies as whether it would be an impairment trigger or not. So I think given the very sharp exposure to such, slight change in these factors can have a huge impact on your asset value. This is a top area of focus from an auditor standpoint also. So we'll be covering in the subsequent slides. Typically, every metal mining company or oil and gas would have a CAM on impairment, right? So every year this is evaluated in that much detail. So which is why from our focus also, we'll have to be very, thorough in terms of procedures that we are performing to cover the risks that is involved in this. So first thing, you'll have to understand is what are the estimates that are going, how do I determine the recoverable value of an asset? So there are two ways to the standard permits you, which is either a fair value or you do a value in use method. The fair value is typically the market participant today, if you were to sell that asset, including your exploration, evaluation, all the assets together, how much would you fetch? Whereas in a value in use will be if you're in the existing capacity, what is the discounted cash flows that you would expect? So both these methods would have similar inputs, which is either you will have your future production, future price, future cost, which would be your capital, production cost, abandonment cost, taxes. So then you estimate the future cash flow and then you have a discount rate. So all of these things that I just mentioned, which is your production, price, cost, discount rate, all of these are estimates. These estimates are very crucial to determine the recoverable value and also highly sensitive. So then we'll have to break these down into what is the risk category of these estimates. Are they high risk estimates or are they, very like a slight change in them can have a huge impact on my recoverable value or is not too much. So like I said, in metal mining, abandonment is not maybe that critical. Whereas in an oil and gas sector, it may possibly come a little under the higher risk category. So you'll have to each estimate, we'll have to determine what is the risk involved in that. So once you determine that risk category, the next step is you have to understand how are these estimates developed. That also plays a huge role into determining whether it requires additional focus by my side or I can probably do the basic procedure. So that means, is it something which I can back with publicly available data? Is there a potential management bias in that particular estimate? Usually, when you don't have external data and you're moving on a growth model, you're saying business is going to grow 10%, 20%. So that growth is more internal than it is external. So then in that case, that growth factor becomes really a high risk category, because if that growth is not there, we'll have to see what is the potential impact. Then you will see, is there any other way that I can test? Do I have past period information to test whether this estimate is, reliable or it is susceptible to huge change, right? So the level of estimation uncertainty that is there, like in reserves, I said that every year more data you get, there's inherent uncertainty that exists in reserves in general, right? So that again would be under the higher risk category. So the moment I determine which one is high, medium, and low risk, the higher risk category determines obviously requires most amount of attention, where you will have to perform all the procedures, including sensitivity analysis, benchmarking with external data or contrary data. You will have to evaluate to see whether those are appropriately identified. So once you know what estimates you can this thing, and then you have your recoverable value, and then you determine whether you have to recognize an impairment or not. The other factor to look in here is that because this is an area that most users of the sector, they look towards, right, in the financial statement. So generally, if there is an impairment recognized, generally there's a detailed disclosure that goes in the financials, which talks about the method that you have used. Have you used a fair value? Have you used a VIU? What are the key estimates that you have used? Let's say price or discount rate, production profile, right? So key estimates that you've used. What is the sensitivity with change in these assumptions? So if this, 5% up and down, so how much is the recoverable value going to change? So all of these, or as definitely this is required by Ind AS 36 as well, but this is also something that the users heavily look up to and look for in the financial statements. The next topic is accounting for interest in joint venture. So we've explained before that this is especially for the oil and gas sector. So they, in India at least, they largely function in the JV model only. So it's huge capex involved. Single person does not do it. So at least 2 to 3, in fact, even more parties come together depending upon the size of the operations. They form a joint venture, and then under that is how they enter into the agreement with the government, based on which the operations of that block or that particular area functions. So earlier we used to have the line by line consolidation where the assets used to come and the revenues and expenses used to come in, and then the JV accounting moved into the equity method where you recognize your share of the profits in that entity. But in the oil and gas sector till now, of course, there's an evaluation process which we'll talk about how to determine, whether you have to do a net accounting or you'll have to do a line by line. But generally, in the oil and gas sector, everybody follows the line by line, and we'll discuss why. So the standard that determines the requirement for accounting for GVs is Ind AS 111. There are 3 key things that we need to look at in this. One is that we have to determine what is the type of joint arrangement. So if there are multiple people who are in an agreement, including the government, so jointly as an agreement, so that's a joint agreement. And then if this joint agreement is a joint operation or a joint venture. So 3 aspects you'll see: whether there's a joint arrangement, whether there's a joint operation. So after you determine there's a joint arrangement, you'll see whether it's a joint operation or a joint venture. So depending on whichever side we fall under, that will determine whether we'll have to do a net accounting or we'll have to do a line by line. So, so a joint operation is typically a joint arrangement where the parties have joint control on the rights of the assets and the obligations. So typically the JV itself does not own the assets. It is the venture partners who have the right on the assets, who have the rights on the liabilities, and who basically reap the economic benefits out of those assets and out of those assets. Whereas in a joint venture, the agreement itself is drafted in a way that the venture partners are having the right only on the net profit or loss or whatever the net assets of that entity. So the contract itself is structured in a way. So again, huge judgments goes into determining whether the arrangement is under a joint operation category or is it a joint venture. So you will have to read through the agreement to determine whether what is the rights and obligations for. Is it for the assets, liabilities, revenue, and expenditure, or is it for the net accounts? And then we'll have to see what is the legal and structural form of the arrangement and the JV, and what is the terms and other terms and conditions which is there in the agreement, which we'll go through in detail in the next few slides. Depending upon all of this is how you figure out which side. And like I previously mentioned, most of the oil and gas industry in India follow the unincorporated joint venture, where they follow a production sharing contract. So there's a contract which production sharing, meaning you share the whole the output, the revenues, the expenditure. So that's why they do the line by line accounting. So the first step to determine whether it's a joint arrangement is to see whether joint control exists. So to determine whether there's a joint control, you have to see whether the contractual agreement or contractual arrangement gives right to all the parties, right? So it should not be that one party has the ability to veto the other. So all of them jointly have to have control over the asset for it to be a joint arrangement. If that is not the case, then this is outside Ind AS 111. We'll have to follow either Ind AS 110 or 27 other standards that are applicable. So once you know that there's a joint control on the arrangement, then you see what the relevant decisions that are being taken in the entity, right? So Generally, in the oil and gas industry, what happens is that while there are multiple venture partners, but there is one operator. So one operator manages the JV operations on behalf of the other venture partners. So they basically, probably sign contracts, manage day-to-day operations, cash payments, exploration activities, etc. And the other parties, pay their respective share. However, even in this model, any strategic decision, so whether you have to carry out a project or not, who should the contract be awarded to, so all strategic decisions, the operator does not have right to do that. It has to be done collectively after all the venture partners have agreed. So, which is why it's important to see is the decision has to be unanimous and it has to be consent of all parties. It should not be that one person has the ability to take the decisions on behalf of others. So, if it's a unanimous consent, meaning all parties together have to agree on the key strategic decisions, then it would be called as a jointly controlled arrangement. Else, it is outside the scope of 111, which we'll have to either follow 110 or 27. So, again, from a joint arrangement perspective, for it to be a joint arrangement, it has to be a joint control. So if you have established joint control, then it would be a joint arrangement. After that, we'll have to determine the next step, which is this joint arrangement a joint operation or is it a joint venture? Now, to determine whether it's a joint arrangement or a joint operation, so the first step, to veto out anything is to see, is there a separate vehicle? So if you are yourselves managing it, if there's no separate JV created for this, then it's clearly a joint operation because there's no segregation and clearly you have the rights. So it's that it can't be a situation that the JV has rights if the JV doesn't even exist, right? Then in the case where the joint venture is there, then you will have to see, which is the right side of this image that you see here. There you will have to evaluate how the contracts, how is the legal, the form of the contract, what rights that does it give, then what are the other terms and conditions which is there in the agreement, and how is the liability sharing mechanism, right? So which we'll discuss in a little more detail. So the terms of the contractual arrangements that's the first step to determine is it a joint operation or a joint venture, meaning the parties have the right to the assets and the obligations, right? So they own the assets and they own their share of asset and their share of liability. JV owns nothing. Whereas in a joint venture case, it is under the JV has the rights, the JV decides what needs to be done. It's just that the venture partners are entitled to the net share. The same thing is again established in the right to assets, where the parties to the joint agreement share the title of the asset and the proportionate titles, whereas in the joint venture, they are only having the net share. Then comes the obligation. So in the joint operations, they share all the obligations. So if the obligation is 100, then each party has to pay their respective share proportionate to their participating interest in the joint venture. Whereas in a JV, the JV handles everything. The joint arrangement does everything. It's only the net, whatever comes after settlement of everything. So nothing can come to the joint venture partners if the JV is not able to fulfill anything, right? So, but whereas in a joint operation, the JV does not itself have its funds. It has to be met by the joint venture partners. So that's the key difference between a JO and a JV. Then again, the revenue, expense, profit or loss is again pretty clear that each party is recognizing their share of revenue. So if, let's say we sold 10 metric ton and each party has got, say 35, 35 and 30. So they are recognizing their share of revenue. They are entitled to the revenues of their share, right? Directly. So then that also says that it's a joint operation vis-a-vis a joint venture where everything comes into the JV and only the net is passed on. Guarantees, again, it could be either ways. If you do have guarantee, you'll have to, in conjunction with all the above factors that we just saw, we'll have to decide whether it's a JO or a JV. So here are a few other factors that we need to keep in mind when we are determining JO versus JV, which is that if the joint venture partners are entitled to the benefit from the sale of the output, right? So if whatever revenues that are being generated is directly being passed on to the joint venture partners, that clear indication that it would be under a joint operation. And the other thing is that they're also earning the revenues, and they will also have to meet up any shortfall that comes across in the operations. Again, this is a summary of everything that we just discussed. It is to see whether the rights and obligations for the party, is it on the assets and liabilities, revenues and expenditure? If yes, then it would be a joint operation. Then does it, do the entities have, are entered like liable, or they are eligible to reap the output, the benefits from the output? Or if the liability settlement is on the joint venture partners, then that would be a joint operation, else it would be a GV. So the summary of what we just discussed. So if you, after evaluating the entire contract, and if you fall under the joint operator category, then you will have to do a line by line, which is your whatever assets is lying there in the JV, your share of that asset you will recognize as an asset in your balance sheet. Their liabilities you will recognize as your liabilities under the same head in your balance sheet. The revenues, your share of revenues, you'll recognize as revenue in your P&L. The expenditure, your share, you'll recognize as expenses in your P&L. It's like line by line. Whereas if you fall under a joint venture category, whatever the net assets is, you'll recognize your share directly under the equity method, unless you follow someone. Okay, so the next topic is inventory valuation. Again, very crucial, very different and peculiar in the metal mining and oil and gas. Unlike your other industries, manufacturing, where the auditors can go and physically count and be present in the management counts and probably do a floor to sheet and sheet to floor. Here it is, it's not possible. So in the inventories, mine inventories, you will have your ore. Ore is basically rocks, right, which has ores in them. Then you have crude oil. You will have, again, ores, concentrates of ores, which is basically ore in a powdered form. And then you will have the finished goods, which would be in the form of bricks or sheets, right? So this intermediary process, which is your ore mines or your concentrate and your crude oil, so this is where the most amount of challenge comes, right? So typically what happens is that when you've done all the blast and you've extracted all the ore mines, and it's kept in like a heap shape wherever you're storing it for further processing, right? So as at the reporting date, you will have to recognize that inventory in your books. So that's a rock. It has ore content in it. It's not, the entire rock is not ore, it has ore content in it. So you will have to first of all determine, how much of ore content in it. So, and then you value the cost of that. So how do you determine how much of, metal content is there in it, right? So typically what happens is a drone methodology is used for this. So you see the height of that heap, and then you see the circumference that is there. And then depending on that, there's various lab tests that is done. And then based on the height and the circumference, there's a calibration that's done. And then you determine the potential, the volume basis, how much of, ore metal is there. Now to this, further, there are two additions that is done, because there's a lot of moisture that is involved, in this industry, the moisture and, the metal content. So if you process, let's say, 100 ton of ore, it's only possible that only 10% or 20% comes out in the form of zinc or lead or silver or whatever, right? Entire thing doesn't translate into your ultimate finished product. So then you'll have to determine both of these, which is done on a sample basis. So out of the heap stock, there are lab personnel who are always there in the physical verification, who test a certain portion of this inventory pile. Depending on the studies that is there from a moisture content and the metal grade, that is applied on the larger pile. Similarly, in the oil and gas industry also, the crude oil, whatever is extracted and that you've not sold, is in storage tanks. So that also you cannot, it's in a liquid form, you can't count per se. So that also there's a dip that happens. So height, based on the height and the circumference, that's how you determine, again, volume based, you determine how much of oil quantity that is there. So again, this involves, but the standard says that you will have to physically attend the count, you have to inspect, you'll have to do a sheet to flow to sheet, you'll have to see how the management is doing this. All of this may not be entirely be able to be performed in this industry because of how it is structured. Which is why, again, in this case, we have to heavily rely on the experts to do it. While we are present, we fully observe, we're supposed to be present and fully observe how it is done. However, still a heavy reliance is there on the expert, and we do have to perform all the procedure under 620 that we have already discussed to determine if the quantity is appropriately identified. Moving on to litigations. So all of the both the sectors, metal mining, oil and gas, are based on contracts, right? So there's a license contract you have for a particular period that has certain guidelines of how these operations must go. So you would see any large metal mining and oil and gas would have litigation as a CAM also, because of the judgments and interpretation differences that the contract itself can carry, and which is open to a lot of litigations. So again, in accordance with Ind AS 37, whenever there is a litigation, which is you'll have to again determine, you'll have to see what are the facts of the case. You'll have to determine based on that whether it is a possible, probable, or a remote category, and depending on whichever category it falls under, possible, then you will have to show it as a contingent liability in your financials. Probable, that you'll have to recognize a provision. Remote, then you'll have to just keep tracking it. Right. So this is the management's part. So from an audit consideration perspective, you have to inquire from the management and the legal counsel in terms of how they view this, because there's huge amount of judgments, huge probably amounts involved as well. So it's very critical to understand the merit and both the procedural aspect and the merit aspect in determining the classification from probable, possible, and remote. And you will also have to read the minutes of the meeting to determine from a completeness standpoint, are we missing out on anything? Review the legal expenses just as to see if there are any new potential outcomes. And again, you will have to communicate, you will have to send lawyer confirmations to see what their assessment is of the litigations. If it is of that magnitude, it is also important maybe to have a direct conversation with the lawyers to understand. The last thing is very important is to read all the regulatory communications that is there, the communications between from and to the regulatory authorities, to see any potential existence of a possible litigation. Again, like I mentioned, litigation is like a huge, focus area as well. Every large company has got large litigations and is part of the CAM, which means a huge focus goes into determining and the level of judgments also, because the contract itself is so complex. So that's why the level of judgment is also very significant. That rises up to the level of a CAM. So here are a few other, smaller aspects to take care of. So because you're using the government's land, so, they charge either, there's a form of tax or royalty that they collect from both the oil and gas and metal mining players. So in oil and gas, it's in the form of a profit petroleum. And, in mining, it could be royalty or mining tax, right? So there's royalty also, which exists in oil and gas as well. Sorry. Now, typically, because it is used, it's a tax that you're paying to the government. So there's a question as to whether you show it as a tax or whether you show it as an expense or netted off from your revenue. So there's guidances that says that because you are not even entitled to that part of whatever. So if you're extracting a certain amount of quantity, upon extraction itself, there's an amount that is due to the government. So it's revenue or production linked. So because it is revenue or production linked, it is not technically a profit linked tax. Hence, in this industry, you will commonly see this directly adjusted either from the revenue or shown as an expense, rather than showing it as a tax, right? And then, we'd initially discussed, you've got various phases, which is your exploration, evaluation, development. So it is possible that during your exploration and evaluation phase, you might extract some, oil content, right? So whatever sales you do from it, you have to reduce it from your cost of the asset. A few other matters. So moving on to the next critical topic, which is climate. So I think over the last few years, discussions on climate risk has gained so much traction. It um, the level of focus that geographically nations, developed, underdeveloped, developing nations are all focusing on is to move to sustainability. The focus on sustainability has increased. Level of tracking of emissions, policies that is being discussed, carbon taxes that we just discussed. There are at least 53 jurisdictions where this tax is already there, and another 49 where it is under evaluation. It's possibly coming up in a few years. So this is the most biggest industry focus area that is there. And metal mining and oil and gas being the largest contributor to, from an emission standpoint, the policies, the regulatory updates, and generally the impact because of this is very high on the metal mining and oil and gas sector, right? And till now, at least globally, we just have disclosure standards for disclosure standards for climate risk, and we've got certain mandatory, again, net zero emissions, like we discussed, few companies were going till 2050, and so targets. So if companies have got targets, and there are a few reporting standards as well globally. However, in India, it's not come yet, but given the focus, given the kind of attention that this topic is gaining, it's about time that in India also this is going to probably come in very soon. So even though today there is in India, we don't have a specific requirement with respect to addressing a climate change or risks to carbon emissions. But because the sector is so much exposed to this, it is important to see the potential impact of it. So in order to understand what is the potential impact of climate risk on these two sectors, you need to see what is the commitment that the company that you're auditing, you need to evaluate what are the commitments that they are making, right? So let's say if the company is planning to go net zero, the company voluntarily wants to go to net zero by 2030, while it may not be a contractual obligation. There's no legal restrictions on that, but voluntarily if they want to move, right? So that needs an evaluation both from an asset's useful life perspective. When you're doing your impairment, have you factored in those costs? So these are certain factors which you need to consider even today, even though you don't have a climate risk standard or a reporting requirement. India 16 requires you to look at, or 36 requires you to look at the projections to see if all factors, costs have been factored in. If this is a cost that the entity is expected to incur, then that indirectly it is getting covered, right? So these are certain account heads existing that is, impacted due to climate change without any regulatory updates on this. And the first being a disclosure requirement. So most companies have already started giving their voluntary, on maybe not in the financial statement, but at least they're giving it on their websites, what climate targets they have. So if it is that material, you may consider giving a disclosure in the financial statements as well. Now, given the global traction that this particular aspect is getting, SEBI has also introduced BRSR, which top 1,000 listed entities have already started giving last year, and audit on those BRSR principles are being issued in the current year. Infosys or annual report has already come out, which has got both these aspects, which I highly encourage everybody to go and see, just to see how this this topic has been rapidly evolving, in the last few years. The next topic is on property, plant, and equipment. So, like I mentioned, that the climate, if you know that you're going to move to a different renewable source, it could be possible that you would have to discard your existing asset, or you'll have to make significant update to it, which means that maybe you have to redetermine the useful life of that asset, or you'll have to see whether the residual value of that asset is there or not. And further, if you know that you're not going to maybe do this particular activity, then you need to see, should I, factor in, prepone my decommissioning activity or not. So all of these factors with the existing standards are getting impacted, right? So again, impairment of assets, like I already mentioned, your forecast should have an impact. If you have commitments, if you know you're going to move into that sector, then as in if you're going to have expenditures in relating to your net zero targets or other sustainability targets, your projections have to be factoring that. Then again, potentially if there's any contractual obligations or that also have to be factored in and recognized. And again, when you're doing a fair value measurement in that as well, you will have to ensure that, at least from a market participant approach, you've considered the impact of climate risk. So these are certain accounting considerations, even though there is no reporting requirements or regulatory requirements, existing standards getting impacted because of the traction that this topic is getting. Now, as auditors, we need, like I mentioned, we have all the accounting aspects that link to each account caption that has a direct impact due to the climate risk. So we would have to determine if it is that significant, right? Either we determine if it's significant, we determine just with a disclosure. And if it is very significant, which is possible in this industry as well, given the emission status, whether it rises to the level of a CAM. So you will have to determine how much the estimate change because of this particular thing is impacting your recoverable value. That if it doesn't, and if it is even bigger than that, you'll have to evaluate whether do I need to give an emphasis of matter on this topic or not. So I think we had looked at a couple of global entities as well. So like I mentioned, globally already this thing is there's a robust reporting. Most companies have already started giving a CAM on this topic, which we'll be covering in the next few slides, which means that we as auditors need to proactively look into this area and start discussing with the clients and developing, methods and models by which this can impact your accounts and it's appropriately addressed. So here are a few summary examples of CAMs that we've got. So the first thing is from BP, where they have given the energy, climate change and the energy transition as a CAM. So their key aspect over here that they've focused on is that because of the relationship between the price and the the supply and demand due to the energy transition, there's a huge volatility that is expected. So that has an impact on the functioning of the company and the recoverability of the asset. And again, the decommissioning expenditure that you would incur also has an impact. If you're moving, if the companies have to do 2050, you may have your field life also till 2070. But if you're moving to a net zero by 2050, you will have to speed up your decommissioning. That could also have an impact on your asset value. Then you have the if you have ongoing exploration and evaluation projects, which possibly are for a longer duration, and if you know that climate change is happening, then it is possible that you may not be able to complete those projects or decide to leave those projects midway, right? So again, these are few key aspects why the judgments involved over here is why they consider this to be a CAM. So what audit procedures we're going to perform? So again, this is linked to impairment. So just probably recollect the points that I mentioned when we were doing impairment a few slides back. So they used an expert who would give them the potential forecast of demand and supply and how the climate change is generally impacting the industry. So those reports they have used to determine what productions, supply, demand, prices do they have to consider? Again, they have looked at contrary external data, market data available to determine what is their supply and demand strategy. And then they have used other management as analyst report, which, uh, this is specific to the exploration and evaluation, is whether these things can be continued throughout these things. So heavy use of experts, because it is so volatile. It's an evolving topic. There's a lot of uh, every day something or the other is changing. So heavily this area uses the use of experts is again heightened. Always this area generally uses a lot of experts, but it's heightened because of the traction of this topic. Similarly, we've got this is Glencore, which is again an Australian-based mining giant. So even they have also called out climate change as a CAM. So they have also said this because of the climate commitments that the company has. So they have their own commitments, okay, which involves going to net zero, having their emissions in check, and then they also have the same estimation of rehabilitation and decommissioning closure activities. So similar concept, just a different entity, and even they have heavily used experts. So valuation experts, they've used external benchmarks, IEA's reports, EIA reports, all the other reports, and they've also used, from a production perspective, they've used their experts. They've also understood, the impact on decommissioning because of the change in the policies, change in the strategy of the company, whether any decommissioning activity has to be speeded, right? So I think this is specific to the climate risk CAMs that we have seen so far. So here are a few other CAMs that is common in the oil and gas and metal mining sector. So I've already mentioned it's very common. You will see reserves, you will see impairment, you will see litigations. These are common. And there are a few others which I'll quickly run through in the interest of time. So oil and gas reserves, again, so it's CAM is basically like any topic which involves significant auditor's attention and that has a lot of judgment involved in it, right? So two large criteria which put something up to the level of a CAM. So oil and gas reserves clearly, as I said, meets both of those criteria, because again, there's judgment, there's estimation that's going into it, and the impact that this estimate has on the financials is also very large, right? So again, they have called this to be a CAM because of the significant judgments and estimation that is involved. And so if you look at the procedures that they have performed, so they've done the walkthroughs to see that what is the process the company is following first to determine the oil and gas reserve, to see if there's any potential design gap around it and if it's operating effectively or not. Then you will have to see the objectivity and competence, like I mentioned, in accordance with the auditing standard. You have to see the objectivity and competence of the expert. Then you'll have to look at whether the depletion is accurately computed or not, which you've already discussed. You will have to see the disclosures that is made. So in oil and gas, there's a specific disclosure also that is required, wherein you give what is your proved and probable reserve and your overall, reserve portfolio. So you have to look at all these disclosures as well. So next is in Reliance itself, we've got litigations. Again, like I mentioned, you will see this commonly in most of the entities, that litigation is there in your most oil and gas, which is either a dispute on the taxes that you pay to the government, or some new taxes being levied, right? So again, here they've tested the controls, they've discussed it with the legal counsels, like we discussed before. You have to speak to the legal counsel, you have to understand the merits of the case, you have to understand both the merit and the procedural aspects, and both have to be fulfilled, and not just the procedural aspect of it. And then you'll have to keep on monitoring the litigation status. Every year you have to take a direct lawyer confirmation, and you have to see all the disclosures that is made in this regard, and the representations have to be taken from the management to make sure from a completeness perspective as well. On the recoverability of receivables. So again, here in the power sector, there is, PPA, based on the PPA, there are a lot of disputes that are going on. So you again here, they've looked at the controls. They have seen what is the regulatory requirement, what does the contract say, what is the parameters that is involved, in the demand. And then you do, on a sample basis, you're checking whether the computation the management is done is right or not. And then you basically do procedures around the overall receivables. Again, there is estimation involved in determining how much of claims that are recoverable, which is why, and given the amount that is outstanding, hence this rises up to a level for CAM. This is again impairment. We've already spoken about impairment. So again, we'll have to, there are a lot of judgments involved, estimates that are going in. Hence, this rises as a CAM, and you will have to, again, look at the valuation model, perform control testing, look at the key assumptions, see the alternate data, look at the market data, alternate data which is there from the client, past performance. Based on that, you perform your audit procedures. Again, this is impairment as well, very common. JSW has also given this. Same procedures, again, heavily reliant on experts, benchmarking data, using, performing competence, capabilities, and objectivity procedures on the experts. The disclosures relating to this have been accurately made or not. Again, this is relating to litigations which we've already discussed. This is similar to the power PPA arrangements. Again, this is recoverability of this. So I guess, I think in gist, I'd like to say that this macroeconomic factors contribute to a lot of uncertainty in this industry, which is why impairment is, and climate risk is the hot topic. The industry, climate risk is obviously evolving, and the growth in this sector is also happening a lot in India. So we might expect more metal mining and oil and gas players to come through additional FDIs, hopefully in the next couple of years, which will make this an even more important sector to focus on. I believe, I really hope that I was able to explain every, pertinent issues in the oil and gas and metal mining sector to all of you. Please feel free to reach out to me if you have any questions. Happy to answer them. And thank you very much for listening to me throughout this session.
Thank you so much, ma'am, Kirtana madam. It was wonderful deliberation. Both of you, Chuk sir, as well as yourself, has deliberated in a very efficient manner, and you have covered both these sectors. And we are trying to fetch certain questions, but due to the technical glitch, we are unable to fetch the certain questions. So what we will do, we will receive the questions from the members, then I will forward to you on mail, and whatever will be the solution, then I'll forward to the concerned member. So now we are going to conclude the session. So thank you so much on behalf of AASP of ICI for sparing your valuable time and enlightening all of us on various intricacies of both these sectors while auditing of this mines and metals and mining and oil and gas sector. And I hope our participants have gained a lot through your deliberation. I also extend my thanks to both the moderators, C. Ankit Sharma ji and C. Rakesh Kedia ji, for moderating our today's webinar. So once again, thank you so much, both the learned speakers, for sparing your valuable time. Thank you so much, ma'am. Thank you so much.
Thank you very much. Thank you.
Thank you. Thank you, ma'am. Thank you, ma'am. Thank you.